Hi everyone, August Biniaz here with CPI Academy. I'm joined by 𝗖𝗽 Benesocky. Welcome, Eva.
Thank you, August.
We host CPI Academy YouTube show dedicated to adding value to our viewers' investment journey. We bring on experts and discuss all topics related to real estate investing.
All right, thank you, August. And hello, everybody. Thank you so much for joining us today. I'm really excited about this episode today because we are joined by Travis Watts. So welcome, Travis.
Welcome, Travis.
Thank you guys so much. Appreciate the invite.
Awesome.
Incredible.
Awesome.
Travis, let's just get to it. Let's start off by you telling our viewers a little bit about yourself, please.
Well, sure. There's a few ways I guess I could approach that story, but I'll tell it this way, I guess. So as a child, I was raised by two very frugal parents. So money was always a topic of conversation, but it was really surrounded by personal budgeting, using coupons, buying the off-brand, not buying things we didn't need. So I learned some lessons about frugality early on, but up until 18 years old, I really had learned zero about investing. Okay. And so what I've discovered over my entire journey thus far is that, that's the side of the coin that can make the biggest impact on your life is the investing side. So very grateful for those humble beginnings, but yet what I'm here to share with everybody today is more on the investing side. So I got into real estate when I was 19 years old, bought a single family home out in Colorado. And I did house hacking. So I rented out a spare bedroom to a college student. It was in a college town. And, that was a big eye opener for me. I was buying, number one, in 2009 in the fall. And so real estate had come crashing down. I was buying at least a depressed level, but I didn't know if it was going to keep going down or not. So that was kind of my risk. But I knew at the end of the day what my mortgage payment would be, and then what this roommate was willing to pay in rent. So when I was collecting this, I think it was like a $600 check, and I had a $650 mortgage, it was kind of an eye opener that, wow, I'm almost living for free, right out of college. So it taught me a lot about passive income, cash flow, leverage, just the power of real estate in general, and all the creativity that could be added to real estate. So one thing led to the next. From 2009 to 2015, I did house flipping, fix and flips. I had some buy and holds. I did some vacation rentals, but I was trying to do all of this actively, everything on my own, because I didn't have any coaches or mentors or any kind of investor network. I certainly didn't have resources like what you guys are putting together here. And that was a big mistake, quite frankly. I just assumed I could do all this on my own and that I didn't need any help. But what happened is I burned out. By 2015, I just kept acquiring properties. I was a very busy W-2 worker. I worked in the oil industry, and working 100 hours a week away from home and overseas wasn't exactly helpful, I guess you could say, when you're trying to scale up a real estate portfolio. So in 2015, something kind of crazy happened, and I finally did reach out to a network, and I finally did join real estate groups, and I finally did listen to podcasts, and I finally did read a ton of books on real estate investing. And what I discovered in that process was that you could actually be a passive investor in real estate. You don't have to do it all on your own. You can partner with people who actively run the business plan, and you're passively investing alongside them. So from 2015, that just made such an impact for me. That was my big aha moment in life, one of them anyway. And I made a complete pivot from single family investing, all within my own backyard, so to speak, about a 50-mile radius. And I expanded out to nationwide investing in all kinds of markets with different sponsors and things like that, where I could participate and get monthly income and participate in equity upside that happens so often in real estate, but not have to be finding these deals and underwriting these deals myself and working with realtors and brokers. So what I do today is I just help educate other folks looking to do the same. There's a lot of folks that are maybe doctors, dentists, lawyer, attorney, pro athlete, you name it, people who are focused on their career and do have excess capital to go put into investments. And perhaps they don't want to put everything in the stock market. So this could be a good, diversification piece. And so I'm helping educate people in what I do full-time, what most people do probably part-time, which is being a limited partner in a multifamily syndication for the most part. I do invest in other asset classes, but in a nutshell, that's it. and I'm Director of Investor Relations with 𝗖𝗣𝗜 over at Ashcroft Capital. And that's exactly what we do as a company, right? We're a national multifamily syndication firm doing a lot of deals in Texas, Florida. I've been an investor with them for many years. So I joined forces a couple of years back to get a wider reach and to help more people.
Incredible. Great journey.
Yeah.
And it's great how the progression has been there, where you started out, being, realizing that, hey, this real estate could be a great investment, and being in almost even as far as cash flow went, and paying your mortgage, and then moving on to, fix and flipping, as you mentioned, and then becoming a limited partner. Now, you mentioned some great points as far as being a limited partner. There are a lot of benefits in being a limited partner, because you allow the general partners, the sponsors, the operators, the person managing the project, you allow them to run and basically race for your investment. You can pick and choose as a limited partner what group you want to invest with, what region and area and state and country you want to invest in, and the general partner gets compensated in most cases relative to their performance. So it's a beautiful concept. A lot of retail investors, everyday investors looking to invest in these type of investment vehicles, don't realize that this was initially created for large institutions such as pension funds, university endowments. They would use the same kind of concept to partner with other asset management firms to then invest with them, and they would do the same kind of concept through mergers and acquisitions, and they charge management fees and performance fees. Now, this idea of a real estate syndication or apartment syndication, as 𝗖𝗣𝗜 I believe has created that term. He's definitely wrote the book on it for sure. But this is available to the retail everyday investor. So really enjoyed listening to your journey and also the limited partner or investor perspective of it.
And because you were an active investor to begin with, and then you went to a passive investor, maybe you can share your thoughts on the pros and cons about passively investing and being an active.
Great question.
Yeah, I'm glad you brought that up, because, I never want it to sound just too frou-frou, right? Like the only way out is, passive investing and it's all icing on the cake. It is certainly pros and cons. So the thing about active is usually you should want to be in the business of real estate. You should enjoy the process of finding properties, doing underwriting, whatever it is you're going to be doing, capital raising, managing contractors, et cetera. All of these are components to being an active investor. For me, unfortunately, just diving in head first with no perspective, I didn't realize that I didn't enjoy that process myself. And then number two, most importantly, probably, I had no competitive edge. I thought I was doing great, and, in my little bubble. And as I met and mingled with more and more people during that time who were doing fix and flips and vacation rentals, and I'd get to talking about, what kinds of returns they're making, et cetera. And I quickly realized I'm an amateur. I'm not doing this at all at a professional level, nor do I really have the time or want to give the time to get to that level, So with active, you certainly have the control, which is a big thing, right? I can decide what I do, whether I, sell a property early or refinance it or switch out the tenants or convert it from this to that or the other. I have control over that. And that's a big thing for so many folks. If you love having control, active investing might be a better approach. When you're a passive investor, what I'm doing is I'm looking for an experienced team that has a track record, a proof of concept. They've done this before. They can show me those results. They're being conservative in how they're approaching this business plan. And I am putting my trust in that team to go out and execute that business plan in hopes that they can actually pull off what they're telling me they think they can pull off. But truthfully, at the end of the day, it's an illiquid investment. I'm putting in whatever, call it $50,000 or $100,000. I'm not going to see that money for 5 years, maybe 7 years, maybe 3 years. Like, nobody knows, right? There's not always a defined exit to these things. And I have virtually no control over the business model. But the benefit to it is I get to diversify in many different markets, many different states, among many different sponsors and different asset types. So I feel very diversified, even though I've got a lot of my portfolio in real estate in a general sense. But I'm trading control for diversification, I guess is probably the simplest way to put that. And again, back to, who are the ideal candidates, I guess you could say, for passive investing. It's anyone that doesn't have the time to dedicate to the business of it. I like to use an analogy between stocks all the time, so you could be a day trader in stocks, constantly in front of your computer and tracking the trends and up and down and every day doing this. But other people say, I'll buy an index fund and I'll let it ride. I'll check in a couple of years and see how things are going. So everybody's different. I don't feel I have a competitive edge in day trading stocks or in active real estate. So I decided to be on that passive side of things.
Nice.
Great. And on that control point that you brought up, great point that you mentioned. But the way I see it, when I put my investor hat on and I see, hey, I'm investing with an operator now. Their business model, the business plan was to exit in 3 years, and now it's taken a long time. It takes 5 years. There were certain promises made. Maybe the asset is not being operated as well as they should have. My control is not to invest with them on their next investment, to switch groups. But if there's reasons, if there's issues that always happen. There was some plumbing issue and certain amount of expense went through that. That's understandable. I will work with that operator. But the control is the decision the passive investor can make to possibly even invest with multiple operators at the same time. And if a certain operator doesn't keep their promises they've made or projections they've made, or they're way off, then you can switch teams as easy as that.
Absolutely.
Exactly. Yeah. And that was my approach. My journey in this has been quite comical, really, from 2015 through today. So I spent about, if you run the numbers here, about 6 years active, 6 years passive, right? Kind of been 50-50. So in 2015, the first deals that I invested in with operators were local operators in my own, city that quite frankly weren't that experienced and quite frankly couldn't really execute the business plan like I was hoping for. And I felt a scarcity mindset because I just didn't have the perspective yet to realize how many of these deals are really out there and how many opportunities exist. I really thought there was just, a handful in a given year. And so I really had to just make a decision. I'm in or I'm out, and that was a mistake. And so, yeah, to your point, I eventually, by deal 5, 6, 7, somewhere in this range, I started shifting gears to more experienced operators, folks that, I would mingle with, and they'd said, oh, I've done, 10 or 15 deals with this group over here. It was kind of a word of mouth kind of reference. And so that's how I got synced up with Ashcroft Capital in the first place. And, it's interesting, there definitely is a sweet spot, maybe investing with someone on their first deal is not always a great idea. It might be. But then again, trying to wait till, I'm only going to invest with folks with 30-year track records, et cetera. Well, you may not even get into their deals. Most often they have too many investors in line, not enough deal flow. So good luck trying to get in on those deals. So you're trying to kind of ride a wave, I guess, so to speak, in the middle of that range.
Sure.
That's right. And you know what, Travis, that leads me to my next question for you. Before someone starts their passive investment journey, I'd love to hear the advice you give about knowing yourself, setting goals, and identifying your risk tolerance and investment criteria is crucial.
Exactly. I really thank you for bringing that up because I didn't get clear on this till far too late in the journey. As I mentioned, I got started just head first diving in. And again, it's kind of comical to look back and think, why was I doing vacation rentals? Why was I doing fix and flips? Like, why? And it's interesting because I couldn't have given you a good answer back then as to why. But when I got serious, the thing that resonated with me, for anybody listening that's familiar with the FIRE movement, financial independence, retire early, it's usually these folks who are working high income jobs, saving by frugality, which was kind of my background, and then parking that excess of capital into some kind of investments. I would say most of those folks are probably doing stock market stuff passively. But for me, it was real estate. And so that was kind of my way in. My concept was I want to have more passive income, ideally on a monthly basis, than I have lifestyle expenses, mortgage, rent, insurance, food, et cetera, so that I can have, it's not about money to me, it's about flexibility and freedom over your time. And what was happening in my life is I was stuck in this, I can't really call it corporate, but I was stuck in the oil industry, away from home, didn't have time to do anything, couldn't travel, couldn't vacation, couldn't even hold down a relationship for many years. I was just too busy. And I thought, this is no way to live your life long term. I have to get out of this, and I need to start pursuing things that I'm genuinely interested in. And cash flow is what got me over that hurdle. So for anybody thinking about passive investing or why, to me, it's about what I call time freedom, and it's trying to build up enough of that passive income or cash flow to offset lifestyle expenses so that you can spend more time with your family, so that you can travel more, so that you can retire, so that you can go to part-time work from full-time, whatever it is. Everybody has their own thing, right? But it's really about flexibility of lifestyle versus money, at least in my opinion.
That sounds beautiful.
For sure, yeah. And Robert Kiyosaki, obviously, in his book Bible of Many Investors, Rich Dad Poor Dad, explains this idea of being rich. Your wealth is measured from your net, not how much money you make. Somebody could make $1 million a year, but their expenses, $950K. In reality, they're worth $50,000 a year. So it's that difference between your income and your expense, and allowing that, the larger the gap, the better for someone's life and situation.
Yeah, that was a big, and that's so important what you just point out. So the way I think of it is, well, to your point and to, I guess, Robert Kiyosaki's point. So rich is about money specifically. Okay, I'm a pro athlete or something, and I make $1 million a year, right? I'm rich. But just like you said, if I go spend $1 million a year, I have no wealth, right? If I get let go the next year, what do I really have? I have nothing that's going to sustain me long term. So I would rather be the person with no net worth, but a guaranteed, $100K a year in passive income, right? Because that's wealthy, because now that $100K can carry you along year to year as an income source.
Amazing. Now, if we could also spend a few moments on how this a limited partnership in most cases, which is used to acquire assets, where there is an operator who sits on the general partnership side, and there are limited partners who sit on the limited partnership side. Obviously, there is an agreement between these two sides. The general partner operates the asset, finds an asset, upgrades it, operates it, and eventually makes a decision to exit it, depending on the market and where the business plan is. And the limited partners have limited liability, and they're sitting back and have put their trust with a general partner. Talk to us about, how does a general partner earn their living? Obviously, it's done through fees and the profits. But how is that? And give us a perspective of a limited partner when picking and choosing a general partner. When do those fees come into effect, and how do those get assessed as a limited partner's view?
Yeah, exactly. So what we're talking about here is just, again, the legal term, I guess. So private placements. So they're private, meaning that there's no public market to trade these securities like you would have on the stock market. I can't put in 50K in a private placement and then tomorrow say, all right, I want that 50K back. It's locked in, it's illiquid, for a period of time. So to your point, so the first thing to recognize is on the active side, which is the general partner side, okay, it is a job. You are working in the business of executing a business plan, okay? It's a day-to-day, it's a week-to-week, it's a month-to-month. It is a firm commitment. You're answering to investors, you're raising capital, you're checking in on properties, you're having meetings with property managers, or working with brokers. There's a lot of active components here. So first, recognize that you're setting yourself up to do this as a career, or as a job. So just be aware of that. Some people, I think, I don't know, they go to conferences or something and they think, well, I'm just going to do this part-time. I work 80 hours a week over here, and I'm just going to syndicate some deals over there. It doesn't really work that way. So be prepared. The general partners, you could structure your deals different ways, but I would say commonly, how do you make money? You have an acquisition fee usually, which is going to be a percentage of either the capital raised or a percentage of the closing price on the deal. Again, you could do this different ways, but it's once you close the actual deal, you're going to make 1, 2, 3%, depending on the property size of that deal size. Number two, you usually have an asset management fee. So that's for managing the business plan, right? For hiring the right folks, for making sure the construction crews are coming out and doing what they're supposed to do, making sure you're staying on budget and on time, allocating the right, property management groups, if I didn't already say that. So you're managing the business plan. So that's usually, 1, 2, 3%, whatever. It could be gross collected rents, or you could choose other ways to pin that metric to. And then some you said earlier is key. The main incentive, the main way that a general partner gets paid usually is on the back end or the sale of the property. So if you actually do everything correctly, and as you hope, if not hopefully better than your projections, you get a split usually on the end. So say simple numbers, right? I'm really bad at math, but if you buy $1 million property and then you have like a 70-30 split on the back end, 70% of the equity upside, how much that property's gone up in value, usually goes to, say, the limited partners. And then that 30% would go to you or the general partners, putting the deal together. That could be an 80-20, 70-30, 60-40. People structure it different ways. You can get very complicated with it, but in a general sense, those are kind of the three general fee structures. And so all in all, is there more to be made potentially as a GP? Absolutely. Is it a job or a career? Absolutely. So that's how I looked at it. Is this what I personally want to be doing with my time? 40 plus hours a week. For me, it wasn't, but for a lot of people it is. So just be aware of that.
Great point. I appreciate that. Now, also give us the perspective of the limited partner. When a limited partner is looking at a sponsor or a general partnership to partner with, how do they assess those fees? Of course, there's a spectrum of general partners to partner with. As you mentioned, there's groups that are very large that sometimes they're even oversubscribed. They don't. It's difficult to join forces with them or invest with them. There's also groups that might be very early in their career. So that's the first decision that's made. But of course, what the back end split and the fees that the general partnership charges is also a very important component. Keeping in mind that scouting a deal, finding the right deal to invest in, that's a job within itself. There's some people that actually earn a living and have a career to flip properties. They put a property on the contract and they flip it because they got a great deal or was off-market property and they're just a middleman flipping it. Well, a operator or a sponsor, a general partner could do the same. They could get their hands on a great property and it's well below market price. They could just go ahead and turn around and flip it, but they rather bring on group of limited partners for this great opportunity. So it makes sense in some cases for a smaller firm to charge more of a acquisition fee. But I digressed. Let's focus on, as a limited partner, when you're looking at an operator, how are you assessing those fees and the reasoning behind that?
Yep, absolutely. So everybody, of course, would have their own take. I'm a big advocate for everybody kind of establish your own personal criteria for your own personal reasons, because what my criteria is may not resonate with some. You may not agree with me, but the way I look at fees is, I've seen enough deals now. I've seen thousands of deals now. So I can kind of read between the lines. I know when someone's charging whatever, a 6% acquisition fee, that's a high fee. Say it's a 400 unit apartment building. I know 1%'s a much lower and more reasonable fee. So, what's right for you, maybe, not right for me, et cetera. But this is what's kind of interesting about fees. In general, the old adage goes, higher risk, higher reward. Right. So when you invest with a newer sponsor, newer general partner, they usually, not always, but they usually have lower fees, right, to get investors in. If everything's the same in terms of projections and fees, the question would then be, well, then why invest with someone doing their first deal when I could invest with this group doing their 20th deal? So you need to give me some kind of reason to why I'm going to partner with you, because I am taking more risk if you've never actually done this before. So, and then fees incrementally kind of crawl up, to the point of, some of the fees and even the REIT structures in the publicly traded markets, can be quite interesting. But even the most matured, syndicators usually have a higher fee. But I'll give you, this is how I look at it personally. I'm in a deal. I'm going to use a non-real estate example real quick. I invest in other things besides multifamily private placement. So I'm in a fund that the general partners have a lot of activity that they have to deal with week to week, month to month in this particular business model. Okay. It's a constant, not nearly as laid back as maybe a multifamily deal would be. They're constantly having to do a lot of work. So their fee structure is they take 66% of the profits as a general partner, and then they give the rest to the limited partners, but still net after fees, me as a limited partner, I'm making a solid double-digit cash flow return on an annualized basis. I'm okay with that. They're taking an outrageous fee. They're doing an outrageous amount of work. And they have a track record to back it up that they've been able to distribute to their limited partners for years and years and years and years at this point. So without ever being delayed or missing a payment. So I don't know, it depends. So if I'm a general partner, I'm syndicating a deal, and let's say it's a very small deal. Let's say it's a 20 unit or something like that. Well, I'm going to have to charge higher fees for maybe an acquisition, et cetera, because I need to make enough to make it worth my time. If I go charge a 2% fee on a 20 unit or a 2% fee on 1,000 unit, that 2% fee on 1,000 units, an awful lot of money, and not an awful lot of extra work involved. So that's kind of how your fees adjust, the property size and then the reputation and track record of the firm. So, and then as far as asset management, and by the way, let me give one caveat here. I've seen other deals structured where it's just a flat, like 70-30 split, just straight across the board, right? The general partner is just going to share equally with that kind of ratio. And so there's so many ways to spin it, but just make sure, I think what's important at the end of the day, if you're going to be a limited partner, are just okay with the fee structure. Some people are okay with paying Wall Street half their money in fees, in different products. They're okay with it. And as long as you're okay with it, it's okay. Not something I would do, but something other people would say, that makes sense to me.
For sure. And sometimes in the Wall Street cases, people invest and the person just invest their money into an index, and that's that. You're like, hey, what did you do here with my money? Yeah. But getting back to what you said, I mean, this is precisely what made me fall in love with this concept of real estate syndication, where a limited partner, an investor, can come in and pick and choose who they want to invest in, what asset class, what region, and make that decision. Now, the unfortunate thing is for Canadian investors, there's over 1 million accredited investors in Canada. It's one of the G7 countries in the world. It's huge natural resources, second largest country in the world, a very rich country, very sophisticated country. And unfortunately, real estate investing, there isn't that many great options here. The rent to value ratios are very low. The median home price here in Vancouver and Toronto, our main metropolitan cities, is $1.2 million. So it's difficult.
Cap rates being at 1%.
Yeah, close to 1%.
Yeah. Look at him shake his head.
Yes. So Canadians,
not a good situation.
Canadians are looking over the border, looking at these operators, especially operators such as Ashcroft, which also has a thought leadership platform, which is sending on so much content and so much educational content. Book, like I showed earlier, which is our Bible where we study all the time, is now.
Joe actually sent me a signed copy.
Oh yeah, exactly. Joe, yes, we should have showed that signed copy, but that was great. That was incredible. So what it is that now, unfortunately, a lot of U.S. operators don't accept Canadian investors, Canadian limited partners, because of issues like double taxation and compliance issues they might have on that side of the border. Also, the ones that do accept Canadian investors, they only do it through an LLC. So a Canadian investor has to invest through a U.S. LLC. And it's not that difficult to incorporate a U.S. LLC for a Canadian. But the issue is when those returns come back to the Canadian investors, or when the project is eventually sold and the profits come back, they're going to have to pay their U.S. taxes, and they're going to also be taxed here in Canada. So there is double taxation. What we're excited about, and the platform we've created, is allowing for the Canadian investors to pick and choose what U.S. operator they want to invest in. Of course, these operators are operators that we have partnered with, and they have passed our checks and balances to be part of our group. But we allow for the Canadian investors to invest in these limited partnerships by investing with us through our Canadian limited partnership, and our Canadian limited partnership invests in the U.S. entity, allowing for the process to be fully tax efficient and also, give relief from double taxation to the investors. So we're really excited about this, being the first Canadian group to allow such product. and such systems. So I just had to kind of throw that in there.
Yeah, it was actually cool. The first time I met Travis, I was talking to him about our system, and he's actually the reason why I got a signed copy from Joe.
Amazing.
Because he did the
Amazing.
introduction. So thank you for that, Travis.
Amazing. And we're obviously exploring possibly working with Ashcroft, and because they have such a long far reach, their content. There's a lot of Canadians that are listening to their information and watching their videos. So there's a lot of interest. So we're hoping to facilitate that process as well. But that's a topic of another day. So
yeah, and speaking about books and educating and listening to podcasts and reading and all this fun stuff, I know you're a big believer in all that, Travis. But I have a question for you, and maybe you can touch on where would someone start when they start their educational journey? Because there's so many different things when it comes to wanting to start their passive investing journey.
Absolutely. And first, I just want to tailwind what you were talking about. It's such a tremendous value that you guys are working on and implementing. I think that's fantastic. There's that adage. I think it was Robert Helms from the real estate guys: live where you want to live, but invest where the numbers make sense. And I love it, because my wife and I have certainly lived in places that, we would never invest there. And so that makes it really tough if you're just going to stick with the single family home thing in your own backyard. It may not make financial sense anyway. So yeah, books and educational resources. As I pointed out in my story earlier, that was the mistake that I made. Was I did the first several years with no educational content, no mentors, no coaches. Big problem, big problem. I would have done so many things differently. It's not really about regrets. It's just about, I wish I were more clear up front on my objectives, because I could have been driving straight towards them a lot faster than trying to bounce around and learn new things all the time. And I kept restarting my strategy. It felt like every 12 months, I'd have to learn as much as I could about, doing a fix and flip. And then I got bored of it, and I'd do a vacation rental and I'd get bored of it. And, there's many places you can start, but I think, so the categories might include podcasts, webinars, forums like a Bigger Pockets, local real estate, RIAs, things like that. But the most impactful, at least for me, has been to get an actual real person who is a mentor. And that could be paid or unpaid. I'm just saying in general, because it was such an eye opener. I was quite skeptical, actually. In 2015, I'm looking at some of these syndication offerings, and I'm looking at these projections, and I'm saying, you're telling me I could get the same type of return that I'm getting doing everything myself in these single family homes? And I'm like, that's a scam. Clearly a scam. And that was my initial thought. It really was. And it wasn't until I ran into a couple guys out of a pretty substantial real estate meetup group I'm in. They're in their 60s, and I think one was in their 70s. They had been limited partners, mostly in multifamily, for like 20, 30 years, doing what I do today, but doing it so much longer, at the time, 100% longer than I had. And when they were explaining it to me, when they were being transparent with me, when they were saying, well, here's kind of the average returns that we've got, here's some deals that weren't so great, et cetera, that was the proof to me. The proof really was in the numbers. So if you can, paid or unpaid, try to find somebody doing what it is you want to do and just pick their brain. That could be, like I offer, 15 to 30 minute consultations with people absolutely free. That could be somebody else that personally that might give you hours or weeks of their time, or it might be a program that you join to get that education, and you pay up front. But in most cases, I would say that'd be well worth it to find an actual person doing successfully what you want to do and learning from them directly.
That's great advice.
Awesome.
Fantastic advice. Now, Travis, could you share with us one mistake you made in the past?
I think he said it a few times there, because he didn't educate himself enough or go out there and try to get the information. But go ahead, please add to it, Travis.
Sure. There was, I guess, one other early on. One of the deals I did was, as I briefly mentioned, but didn't go into detail, was with an operator that was new. I think this may have been their second deal, but quite frankly, it could have been their first. And I liked the people. They were great people, and they had high hopes, a lot of motivation, certainty on this is how it goes. This is what we're going to do, et cetera, et cetera. And going back to the pro forma of projected returns compared to what really happened, it was quite a disaster in many ways. Things did not go according to plan. The hold period was way off. The distributions were way off. The projected returns were way off. Thankfully, we didn't lose money, so I'm not complaining too hard here. But the point was to really do your due diligence, and I really didn't. I really just said, "Hey, I like this person. You know, here's $100,000," and that was a mistake. So I think doing your due diligence, which starts, by the way, with self-education. The book you have there, Joe Fairless's Best Ever Apartment Syndication book's a good one. There's so many great other books too. What's the one that Brian Burke from Praxis Capital, he wrote, The Hands-Off Investor, I think last year or the year before. That's a great one if you want to be a limited partner. But each of these books goes into due diligence, you know, and it's a great thing to learn. I think it's a must learn. I would never recommend to anybody you just go place money somewhere not really knowing what you're doing. Those have been the only times I've lost money in investing, is when I did just that. You know, it was like a referral to some group I've never heard of, doing some business plan I've never heard of. And I just said, well, that sounds cool. And the projections look great. Here's my money. And then I lose money because I didn't really understand what was happening.
Well, there you have it. I think everybody who's starting out should contact Travis Watts.
Absolutely, definitely, for sure.
Because he sure has been through the ups and downs and can guide you in the right direction when you're starting out.
Perfect. You have any other questions?
No, I think Travis.
Travis, allow me just make one more point. It's not a question, but is a comment just to blow your mind a bit. So you're talking about private placements and these limited partnerships. So the investors receive limited partnership shares, and these limited partnership shares are not tradable. They're private, so there's no actual stock market. But what's happening, I mean, now with the technology and what have you, and this is for CPI being a newer firm, it's incredible that we have in the pipeline for such offering where the limited partnership shares can actually be tradable. So through our partnership with Token Funder, Token GX is a platform which tokenizes the limited partnership shares and has a secondary marketplace where these limited partnership shares actually can be traded.
So if you're investing with us and your life circumstance changes and our term is 3 to 5 years, you know, you're able to perhaps sell your shares on a secondary market if there's, you know, a divorce, a death, unfortunately, or something happens, and you're like, wait a second, I need to get out of this.
For sure.
The future of real estate is what I like to call it.
For sure. And not only on the negative part, but also sometimes a company that is on a high trajectory, people sell their stocks for whatever reasons they want to focus on another company. So this is the same kind of concepts. Currently, this option is dormant in our company, but it's something that we're working towards. We're working hand in hand with Token Funder and Token GX to allow such options and products. So and it's pretty cool what has been done so far. So I just wanted to kind of mention that to you, share that with you.
Yes, and again, thank you. You guys are great at adding value in so many ways, and technology is incredible. And I should have gave a little disclaimer there when I say that these investments are illiquid. You know, in a general sense, they are. But you know, could I find an investor friend of mine to say, hey, buddy, you know, you want to buy out my shares? I want to do something else with my capital. I'm buying a house, et cetera. That can happen. It's not like you cannot ever do this no matter what. Or maybe going to the general partner and saying, do you have any investors, you know, willing to buy my shares, et cetera, either plus or minus what I got in at. But what you're doing is so much better. And that's a true value add. And quite frankly, one of the bigger cons, in my opinion, to doing this kind of investing, I'm generally okay with the illiquid circumstance because I have a long time horizon. So this isn't money I'm going to need in the next 5, 6, 7 years, et cetera. But yeah, it's a lot different when you're speaking to investors who are in their 70s, et cetera. And you say, oh, we're doing a 10-year fund and it's illiquid. You know, sometimes that's a bit of a turnoff. So great stuff. Thanks for sharing that.
Awesome. So this is great. We're going to conclude or do you want to ask, I mean, Travis has been answering that since the beginning as far as his advice to a limited partner. I mean, you've said that many times now. Usually we ask, what's your best advice to a limited partner? But the whole conversation has been about that. So I'm sure there's been much value added. So we'll conclude our YouTube show now. Thank you so much. Thanks everybody for watching, and we'll go to questions here.
Thanks, August. Thanks, Ava.